An average return of 5% or less doesn't sound too exciting to me to take that much risk. Does it sound that exciting to you? Well, what if we could participate in that index only when it's moving upward and not when it's going downward? You say, well, that sounds like hocus pocus, smoke and mirrors, too good to be true. Well, the reality is it's strategies that have been around for ages. Hi, friends. It's Colin Richards here. I'm president and founder of Lord & Richards, and I'm really excited to be talking to you in this particular segment of the Lord & Richards Show on this subject. Should I put my life savings in the stock market? That's an interesting subject because for some of you, you're still in your building and growing years with your portfolio. You're still going to work, and you're wondering, how do I choose from these options in my 401k plan, right? And some of them put some of your money in the stock market, some in the bond market. You've got cash, you've got real estate. Well, one of the questions might be, well, isn't it true that stocks just do fantastic? And so shouldn't I just put it all there? That's a really good question, because what we're doing at Lord & Richards is we're helping people like you to understand how to invest and use the market as part of an overall plan without relying exclusively on the market being there for you. Because the truth is, the stock market, we could represent that with the S&P 500 index, an index of 500 of the strongest U.S. companies, and it's tracked every single day, every single minute. And it tells us how stocks in general are doing. Or we could broaden that out to a larger index of 5,000 companies called the Wilshire. But whatever you're using to track the market, if you'll just click on some charts at a place like finance.yahoo.com or wherever, you immediately begin to realize, wow, markets historically are all over the place. I've heard from some personalities on the radio that I should expect double-digit returns, 10, 11, 12%, just by investing all my money in stocks. Well, let me give you this example. Since 2000, okay, so 22 and a half years, since 2000, the S&P 500 has averaged below 5%. You say, really? Yeah, a lot of times those too good to be true numbers are being quoted about small time periods, 5 or 10 years. Well, let me ask you a question. How long do you plan to be retired? I hope that it's a 20, 25, 30 plus year retirement, a significant amount of time. Well, let me ask you, if you're only using 5 or 10 year periods to understand the market, do you think it's possible we could be underestimating the risk and overestimating the return? That's why it's so important to get a financial independence review done at Lord & Richards, because what we do is we sit down with you and we take what you're currently invested in and we do a deep dive to help you understand, well, this is what your average return has been if you own this going back 30, 40 years. Obviously, you own different things back then, but trying to get a gauge of what your current portfolio could or would have done. And then this is what losses might have looked like. And too often in investments, in economics, we have rose-colored glasses. We overestimate the upside, underestimate the downside. This, of course, is what a good friend of mine called Keith Cunningham, somebody that I've studied under, calls the dumb tax. He uses it a lot with entrepreneurs who fail to account for potential problems, right? It's that entrepreneurial seizure when we get so excited, and have all the opportunity in the world before us, and then suddenly we realize we failed to account for something and we've experienced a devastating loss. That, unfortunately, in my experience, was what happened in 2000. It's what happened in 2007. Many people now felt that in 2022. And there is a way to plan in advance. Whether you retired in 2000, 2007, 2011, 2022, these folks experience major setbacks if their retirement savings were heavily invested in the stock market. You say, well, what are my alternatives? Well, we want to use the stock market, but there's better ways to use it. You see, on the one hand, you can just own it outright. You can put your money in the stock market and own it. Buy stocks. Buy into the bond market, bonds. Buy into the commodities market, gold, silver, oil. You can buy mutual funds that group them together, or exchange traded funds that are really low cost, basically just an index. But however you do it, you are owning the market with your principal. You have bought in. You will now experience the highs and the lows. Well, let me ask you, with people experiencing greater than a 55% loss in the big crash back in 07 to 09, an average return of 5% or less doesn't sound too exciting to me to take that much risk. Does it sound that exciting to you? Well, what if we could participate in that index only when it's moving upward and not when it's going downward? You say, well, that sounds like hocus pocus, smoke and mirrors, too good to be true. Well, the reality is it's strategies that have been around for ages. It was first developed in the context of good old-fashioned CDs. I call them certificates of disappointment. CDs, certificates of deposit, super safe, right? Backed by FDIC. Growth, long-term, hasn't been that great, right? We got some good rates right now, but not so great. But did you know that back in 1987, what is today JP Morgan Chase, it was called Chase Manhattan back then, developed the first market indexed or market linked CD? You say, well, what does that do? Well, we take that low guaranteed rate of return that you get instead of just reinvesting that small amount and then rolling over our CDs until we roll over, right? What we do is we take that low guaranteed return and we do something exciting with it. We leverage it. We allow the bank or whoever is managing this strategy to take just your interest and risk that. And you know, because we were so conservative with your principal, we can get really exciting with the interest. We can buy options and things that will leverage that money. And that's exactly what these companies do. And so in that type of a CD, they'll buy a stock market index of your choosing. They'll give you a whole list to choose from and allow you, when that index goes up, to participate in that growth and get a percentage of that growth, generally significantly higher than what you would have over time with just your low fixed guaranteed rate. But when the market goes down, here's the exciting part. That index goes down, but you only risked your interest and you never put your principal at risk. We teach our clients how to do this and the vehicles that you can implement in your portfolio to help you develop a plan so that you never experience another devastating loss in the market again. So the question may not be a great one, but I get it all the time. Should I put my life savings in the stock market? People don't say it that way because it doesn't sound very good, but they imply it by the way they're investing. And the answer is learn how to use the stock market safely, investing for the long haul, understanding that stocks don't generate as good a return as you might think, and they generally carry more risk than you're thinking. This is part of a process we call a financial independence review, and it's a discussion we want to have with you, just like we're having with folks every single day, about how you can retire financially independent without worry and do amazing things with the resources that God has put at your disposal. It just starts with a simple call.